All right, today we are stepping into the role of detective. We're investigating a murder, but not just any murder. This one happened in the market. The victim, a once powerful trend. The crime scene, the price chart itself. And our mission, should we choose to accept it, is to learn how to read the clues left behind. These things called candlesticks.
So, that's the big question, right? Can we really put on our detective hats, sift through the evidence on a chart, and figure out what's going to happen next? Well, today, that's exactly what we're going to try to do.
Okay, so let's really set the scene here. Picture this. A market has been trending beautifully, maybe going up and up and up, and then suddenly it just stops. It's dead in the water. That trend has been murdered, and our job as the chart detectives is to get in there, analyze all the evidence left behind at the scene, the candlesticks, to figure out who done it, and more importantly, what comes next.
Now, before we can even think about identifying a suspect, we've got to learn the language of the evidence. What do these little shapes and colors actually mean? So let's get into it and start decoding these candlestick clues.
So, a candlestick is basically just a really clever way of showing what a price did over a certain amount of time. And get this isn't some newfangled invention. This method goes all the way back to the 1700s, created by Japanese rice traders. Talk about a timeless tool. They were pretty much the original market detectives.
The cool thing about a candlestick is how much it tells you in just one little shape. There are really three main parts to every clue. First, you've got the body, that thick part in the middle. That shows you where the price opened and where it closed. Then you have the shadows, those thin lines sticking out, sometimes called wicks. They show you the absolute highest and lowest points the price hit. And finally, the color. This one's easy. It just tells you which way the market moved.
And that color brings us to a tale of two very different stories. If you see a green candle, that's bullish. It means the buyers were in charge and the price closed higher than it opened. But if you see a red candle, that's bearish. The sellers won that round and the price closed lower. Honestly, just understanding this simple difference is the first major step to cracking any case on the charts.
Okay, so we can now read a single clue. It's time to meet the usual suspects. In our market murder mystery, these are the reversal patterns. These are specific formations that have a habit of showing up right around the time a trend is about to kick the bucket.
Now, our first two suspects are tricky because they look exactly the same but have totally different motives. You've got the hammer and the hanging man. See how they both have a short body and a really long lower shadow? That shadow tells us that sellers tried to push the price way down, but buyers fought back and pushed it up again. But here's the twist. Context is everything. If you find this clue after a long downtrend, it's a bullish hammer, a sign that buyers are hammering out a bottom. But if you see that same exact shape after an uptrend, it's a bearish hanging man, a warning that support is fading and the bulls might be in trouble. It's all about where you find it. Next up, we have a pair of suspects that show a really clear power struggle, the engulfing patterns. A bullish engulfing is when you see a big, strong green candle completely swallow up the previous little red one. It's just a total knockout, a decisive win for the buyers. And you guessed it, the bearish engulfing is the exact opposite. A huge red candle completely consumes the prior small green one, which tells you the sellers have just stormed in and taken complete control. That size difference is the key piece of evidence here.
And finally, let's talk about our star witnesses, the morning and evening star patterns. Now, these are three candle clues, so they tell a bit more of a story. The morning star shows up after a downtrend. It's kind of like the sun rising after a dark night, a sign of hope. Its evil twin, the evening star, appears after an uptrend, signaling that darkness, or a downtrend, could be right around the corner. That tiny little star candle in the middle is super important. It represents a moment of pure indecision right before the big power shift.
So, we've found a clue. We've identified a pattern, one of our usual suspects. But any good detective will tell you, you never, ever make an arrest based on a single piece of evidence. You have to wait for corroboration. You have to wait for the second clue.
So imagine we're at the crime scene, looking at the charts, and then we spot it. A perfect hammer pattern right at the bottom of a downtrend. This is a huge lead. It strongly suggests the sellers are running out of steam and the buyers are starting to show up. But it's still just a suggestion. It's not proof. We need more. And then, the very next candle that forms looks like this. A strong, confident green candle pushing upwards. That, my friends, is the smoking gun. That's the confirmation we were patiently waiting for. This second clue completely backs up our initial theory, and suddenly, our case is looking a whole lot stronger.
So what is confirmation really? Well, in simple terms, it's just a fancy word for waiting for the market to prove you right. It means seeing your initial clue and then waiting for the very next piece of price action to agree with your deduction before you jump in. Rushing to a conclusion is how detectives, and definitely traders, get themselves into a world of trouble.
Which brings us to a super critical part of our investigation. What happens when your deduction is just wrong? Because let's be honest, it's going to happen. Even the best detectives on the planet misread the evidence from time to time.
And if you need a reminder of that reality, just look at this number. This shows that a huge percentage of retail accounts lose money when trading complex products. This isn't to scare you, it's to ground us in reality. Trading is hard. And that's exactly why your plan for when you're wrong is arguably more important than your plan for when you're right. And that plan has a name. It's called risk management. For a trader, the most basic, most fundamental tool in the toolbox is the protective stop or stop loss. Just think of it as your safety net. It's an order you set ahead of time that automatically closes your trade if the price moves against you too far, making sure one bad call doesn't blow up your entire case file.
Think about the board game Cluedo. If you make a false accusation, it was Colonel Mustard in the library with the candlestick, and you're wrong, you lose. You're out of the game. That's it. But in trading, a protective stop makes sure that one wrong call doesn't end your game. It lets you take a small, controlled loss, so you can live to investigate another day.
Okay, so let's tie all this together. What is the right mindset for a chart detective? Because it's not about finding some secret magic formula. It's about building a solid, repeatable process.
And here's what that method looks like. Step 1, gather your clues. You methodically scan the charts and identify the patterns. Step 2, you wait for evidence. You have the patience to seek confirmation before you act. Step 3, and this is non-negotiable. You always have a contingency plan using risk management. And finally, step 4, you understand you're playing a game of probabilities. The goal is not to be right 100% of the time. Nobody is. The goal is to have a system that puts the odds in your favor over the long run.
And I love this quote from Steve Nissen. He's the guy who literally introduced candlestick charting to the Western world. He reminds us that real-world crime scenes are messy. And you know what? So are financial charts. The patterns we've talked about won't always look like perfect textbook examples. That's why context is so incredibly important.
So here's the real takeaway. Success in this game isn't about being some kind of Sherlock Holmes who knows everything and solves every single mystery perfectly. It's about being a disciplined detective who has a rock-solid process for managing the one thing you can always count on in the markets, uncertainty.
Which leaves us with one final question to think about. Is trading a solvable mystery, where there's always one right answer just waiting to be discovered? Or is it more like a masterclass in managing probabilities, where the best detective isn't the one who's always right, but the one who's smart enough to survive and solve the next case?